With Ashutosh Bhargava. He's fund manager and head equity research at Nippon India Mutual Fund. Now joins us on the show. Ashutosh, good to have you on board. Let's begin by just getting in your thoughts as to how you're reading into the latest when it comes to the overall markets. Do you think that the fact that we seem to be in our own trajectory, not perhaps taking cognizance of some of the overseas cues, the macros back home as well seem to be fairly steady. What's your outlook in terms of what the markets hold in store? How are you looking at overall corporate profit growth as well when it comes to earnings?
Hi, good afternoon. So last couple of months, there has been high uncertainty related to the war which is going on in the Middle East, and also related to Fed tightening, etc. And last few weeks, I would say those concerns has abated, and the entire focus have come back to the cyclical recovery. And the good news here is that, globally, the worries related to hard landing, the data which is coming, the earnings which are coming, they are turning out to be better than most people's expectations. So this is how we are at a global level. We are going into 2024, which to my mind is going to be a relatively more boring, slow recovery kind of year for the global economy. As far as domestic earnings are concerned, we have just see the conclusion of the second quarter earnings, and here also on a relative basis, earnings have been better than expectation. We have seen overall upgrades in Nifty EPS. Yes, there has been differences in terms of where the earnings is coming from, and most of the earnings surprise are coming from domestic cyclical sectors. But on an overall basis, this is an environment which looks like more stable as far as macro earning related news flow is concerned. And this is how we are entering the next calendar year.
The big sector which has not participated is banks. And for a sector which has not participated, now there seems to be a double whammy. NIMs are coming under pressure and growth will come under pressure after Reserve Bank of India's diktat on unsecured loans. So do you think banks could be the biggest bugbear? And if banks go easy on unsecured loans, it will have a spiral down effect on just about everything from credit card loans to what will happen to a small ticket mobile item and what essentially will happen to the spending.
Nikuj, obviously, RBI is a bit concerned. Only with time will tell whether these concerns are overdone or there is some truth behind, whatever the actions they have taken in terms of risk weightages. But to our mind, when we look at banks in general, what has happened the last 2-3 quarters, there has been better than expected earning performance. This is a sector where credit growth has surprised positively. NIM decline has been much lower than what people were worried 6 months ago. And asset quality concern, barring this small unsecured piece, which is close to 4-5% of the overall banking sector book, there is no asset quality concerns as such. So if you look at next 2 years as well, we are talking about only 12 to 13% kind of earnings growth. And I think despite this action by the RBI, which can lead to 2 to 3 percentage point earnings cut overall, I don't think there's going to be disappointment in earning as far as banks is concerned. This is a sector where valuations are also very reasonable versus their own history, and particularly versus the rest of the market. So I think there has been a good consolidation. There has been some bad news, but I think price-wise, banks are not looking unattractive to us.
Is that the reason why you have actually, as a house, trimmed some of the largish NBFCs from your portfolios?
Ajay bhai, NBFCs in general, we think, the valuations were a bit stretched in general. The NBFCs which we are liking is less into the consumer segment in general, but more into infrastructure, power sector, lending related NBFCs. Or those NBFCs are into auto lending. But in general, consumer-specific lenders in the NBFC space, we are in general underweight. We think, we are in that point of the cycle where liability side would matter a lot more. And therefore, we favor banks over NBFC in general. beside the pockets like, as I said, infrastructure lending, bit of microfinance, and some bit of auto lending.
Okay, so where are you picking your spots now? Where are you looking at some compounding ideas where there could be scope of P expansion and earnings growth?
One theme which we have increased our allocation in general is the power sector theme. So right from your equipment companies to financing companies to utility company, which are generation as well as transmission company, I think we are in a multi-quarter to multi-year upcycle there. And there, if you look at, the visibility and earnings in general is improving. And valuations also remain reasonable. Therefore, there is still some scope of re-rating, particularly given the fact that a lot of institutions were underweight into these names going into this cycle. So we think this sector has outperformed, but there is still more scope for earnings growth estimate to be met and perhaps better than expectation, and some more scope for multiple re-rating across the value chain in the power sector.
You have a very fair argument, Ashu, but within the power space, will you go for power financiers? There is enough fancy for big power financiers. In fact, one of the IPOs also in the same space getting good interest. Transmission companies, wires and cables, or even some of the legacy power companies which are at multi-decade, 1.5 decade high as NTPC. So where do you find better risk reward out of all of these?
Ajay bhai, what we have seen historically, market rewards earnings and positive earning surprise and upgrades. The whole value chain which we have talked about, we have very high confidence that there won't be much disappointment in any of the value chain, be it financiers, utility companies, equipment companies, and so on. So we think, one has to look at holistically, make a portfolio where you're participating in all sort of names rather than, picking one over the other, because within the bigger theme, there can be rotation that would keep happening. But if you're thinking from 2-3 year perspective, I think the entire value chain should benefit.
Look at PFC, REC, some of these stocks a couple of years ago were available at dividend yields of 5 to 6%, and nobody liked them. That is what markets are. Markets, just imagine a pendulum, folks. There is one side greed and there is one side fear. When the fear part is there, that's the time nobody wants to buy. You want to sell. And when the greed part comes in, everybody wants to buy. And I think PFC, REC, the dividend yield, I think it will be still 3.5 to 4%. It's not going to be 5-6%, but the dividend yield in some of these stocks 2-3 years ago at the peak of the COVID was just mouth-watering, that you could actually buy an equity stock and you were getting a bond, almost like a coupon with a yield of 5 to 6%. That's what markets are. Railway stocks, when they went public, they actually went below their offer price, below the IPO price. But today, I think it's the complete, reverse, so to speak. Where do you think there is a serious mispricing in the PSU space? Power we've discussed, but what about railways, defense? Is there any mispricing there?
Obviously, there could be some double counting as far as revenues are concerned, because at the end of the day, a lot of these sectors depend on government spending, and if you do the bottom up, it becomes a bit difficult to justify that there would be so much of spending over the next 4-5 years in all these pockets, including renewable, railways, and defense as a sector. So one has to be selective from here. We are at that point of the cycle where a lot of these themes have been discovered over the last 12-15 months. And from here on, one needs to be selective, have to focus more on the bottom-up work, because not all of these stocks in the overall, each of these themes would really deliver in terms of revenues as well as profitability. So here on, we are more confident, honestly, over power and defense as two of the infrastructure themes versus, say, other themes like railways. So this is our house view, and we would advise investors to be incrementally more discerning as far as, some of these comeback themes are concerned.
Okay. So, Ashutosh, what is your take on the market? What do you think? Where do you think the market is heading? Where do you think the market is going? What are your thoughts? What do you think? What are your thoughts?
So obviously, there could be some double counting as far as, some of these comeback themes are concerned.
The space, I would like your opinion on is the entire EMS space. One is the actual manufacturers, but then the argument is that they are no longer cheap, though there is a lot of new PLI also being opened up by the government. Then there is the software part of EMS, engineering R&D type. There's a big IP also opened around it. Would you play R&D, engineering, manufacturing from the software route or by these new age EMS guys?
Ajay bhai, this is a new theme, but the reality is that we are already seeing a big shift in terms of work which is coming as far as these services exports are concerned. Some part belongs to this space which you're talking about. A lot of these EMS companies would also perhaps keep delivering very high growth. They are at the very initial part of the long-term journey. Again, the same point here also that it will be a bit of some bit of extra work is required in terms of identifying which are those companies which have a serious long runway as far as earnings are concerned. Because at this point of time, you are seeing each and every company in this space is getting re-rated. So we need to see, because at the end of the 4-5 year period, the number of winners would be very selective, 2, 3, 4 winners in these categories. So one needs to definitely participate in this theme because the runway is very, very long. But again, one has to be choosy in terms of the right management and within the EMS space, right segment where you think the revenue runway could be strong over the next 4-5 years.
Ashutosh, thanks much for joining in and sharing with us your sectoral preferences.